So, picture this. You are staring at a standard 10Q filing, right? You're scanning down the rows, and you're expecting the usual rhythm of enterprise software metrics.
Yeah, like a few percentage points of growth here, maybe some slight margin compression there.
Exactly. Maybe a slight beat on top-line revenue if they had a good quarter. You're basically looking for the financial equivalent of a steady heartbeat.
Right, something predictable.
But then your eyes hit the line item for the remaining performance obligations, the contractual backlog.
Oh, man. Yeah.
And you see a number so obscenely large, so thoroughly detached from the historical baseline of the company that your immediate instinct is to assume a junior accountant just completely misplaced a decimal point.
I mean, I actually refreshed my screen when I saw it.
$638 billion.
It genuinely forces a physiological reaction. Like, when that figure dropped on the Q4 2026 earnings call, you could almost hear the collective gasp across all the Wall Street trading desks. I mean, to put $638 billion into perspective, you are looking at a backlog that rivals the annual gross domestic product of a mid-sized European nation.
Wow, a whole country.
Yeah, and it is sitting entirely within the contractual pipeline of a single enterprise software and infrastructure provider. It just completely shatters our conventional frameworks for measuring corporate scale.
It really does. Well, welcome to Talk Tickers. Today we are bypassing the sanitized corporate speak and the dense Wall Street jargon to decode exactly what just happened at Oracle.
Because there's a lot to unpack there.
So much. The mission of this deep dive is to pull apart their Q4 2026 earnings call and deliver a data-forward, opinionated, and totally actionable analysis.
Right. We are not just going to read you the numbers.
No, we're going to dissect the physical engineering, the supply chain mechanics, and the radical shift in capital allocation that actually makes a $638 billion backlog physically possible.
Because a number that large isn't just a financial metric anymore.
Yeah.
It is a macroeconomic indicator. It tells us something fundamental about the frantic, almost desperate global arms race for artificial intelligence infrastructure.
Yeah. Oracle is no longer just selling software subscriptions.
No, they're effectively selling the picks, the shovels, and the entire power grid for the AI gold rush.
Okay, so let's get straight into the hard data because the headline numbers really provide the foundational architecture for this entire discussion.
Let's do it.
For Q4, total revenue hit a record $19.2 billion.
Which is massive.
Right. That is up 21% in constant US dollars. And non-GAAP earnings per share came in at $2.11, which is a 24% increase.
Or 20% if we strip out a specific one-time net investment gain they recorded.
Exactly. Got to be precise there.
But you really have to pause on that 21% top-line growth. I mean, in this startup ecosystem, 21% growth is kind of a baseline expectation, right?
Sure, for a small company.
But when you are operating at Oracle's scale, adding 21% means generating billions of dollars in net new incremental revenue in just a 90-day window.
It's staggering.
It proves that the demand is not isolated to a few experimental AI projects. It has permeated the entire core of enterprise IT spending.
And the full year figures validate that exact point.
Yeah.
Annual revenue crossed the $67 billion threshold for the first time in the company's history.
A huge milestone.
But the metric that really matters to anyone holding this stock, the real engine here, is the cash flow. They generated $32 billion in operating cash flow over the year,
which is
a 54% jump.
Yeah, that $32 billion in operating cash flow is the crucial defense against any skeptic who claims this is just another paper boom.
Because there's a lot of skepticism out there right now.
Right. I mean, in previous tech bubbles, we saw massive top-line growth driven by highly speculative, low margin, or even, uncollected revenue.
Just burning cash to get users.
Exactly. This is the exact opposite. Operating cash flow jumping 54% tells you that this is a highly cash-generative business model. They are bringing hard currency in the door at an accelerating rate.
Which gives management total financial flexibility to reinvest in the underlying infrastructure.
Yeah. Exactly.
Now, when you look beneath the hood of that $67 billion, the internal segment contrast is what really tells the story of Oracle's pivot.
Yeah, the breakdown is where it gets interesting.
Right. So the traditional cloud applications business, like the SaaS products, saw very solid, predictable growth, up 10%.
Which is fine. It's healthy.
But the cloud infrastructure segment, up 93% year over year.
93%.
They are practically doubling their infrastructure business annually.
And that 93% infrastructure growth is the direct mechanism fueling the larger narrative here. It is the physical servers, the networking, the power delivery.
The heavy metal.
Yes. For years, the market viewed Oracle as this legacy database provider, desperately trying to catch up to Amazon Web Services and Microsoft Azure.
The old guard.
Right. But that narrative is dead. A 93% growth rate at this scale means they are actively taking market share in the most competitive, capital-intensive sector on the planet.
Which brings us back to that jaw-dropping metric we hit at the top, the RPO, or remaining performance obligations.
The big one.
Okay, let's unpack this for any listener who maybe isn't steeped in sauce accounting. Let's quickly define the mechanism here.
Good idea.
So, RPO represents the total value of non-cancelable contracts that have been signed by customers but haven't yet been delivered or recognized as revenue by the company.
What's fascinating here is it is the ultimate leading indicator. Think of it like a guaranteed utility contract, right?
Okay.
When a municipality signs a 20-year agreement to buy power from a nuclear plant, that revenue is contractually locked, even if the electrons haven't actually flowed yet.
Because they're legally bound to pay for it?
Exactly. Oracle's RPO just grew by an unprecedented 363% to reach that $638 billion figure.
But, I mean, a backlog is only as good as a company's ability to actually deliver the product and collect the cash, right?
Very true.
Like having a $1 trillion backlog is totally meaningless if it takes you a century to fulfill it. So how does this $638 billion actually convert into the quarterly earnings reports we'll be reading over the next few years?
So management provided a highly specific timeline for this conversion, and it is arguably the most bullish data point in the entire earnings call.
Okay, let's hear it.
They expect to recognize 12% of that $638 billion within the next 12 months.
Wait, 12% of the whole thing?
Yes, do the math on that. It translates to roughly $76.5 billion in guaranteed locked-in revenue for the upcoming fiscal year, purely from the existing backlog.
That is insane. That essentially covers their entire previous year's total revenue just from the backlog conversion alone.
Precisely. And it goes further. They expect to recognize another 34% of the backlog between months 13 and 36.
Oh, wow.
You are looking at a 3-year window where the revenue floor is mathematically secured by legally binding contracts.
So they basically know what they're going to make before the year even starts.
Yeah, and the CFO, Hillary Maxson, explicitly noted that these percentage conversion rates are actually expected to accelerate.
Meaning they might recognize it even faster.
Exactly. This is not some static pool of capital slowly draining away. It is a highly dynamic, high-velocity pipeline.
Okay, so let's pivot to the physical reality driving this. Because you don't just sign $638 billion in contracts in a vacuum.
Well, there has to be a catalyst.
And the specific catalyst here is artificial intelligence infrastructure. In Q4 alone, Oracle signed $67 billion in new AI infrastructure contracts.
Let's just analyze the scale of that demand for a second.
Yeah.
$67 billion in net new infrastructure contracts in 90 days.
It's hard to even wrap your head around.
As Oracle's cloud executive Clay Magorek pointed out on the call, the demand for AI infrastructure is making the traditional cloud computing market look like a rounding error.
Wow.
We are no longer talking about companies renting a few virtual machines to host a website or, run a payroll application.
The old AWS model.
Right. We are talking about nation states, sovereign wealth funds, and trillion-dollar tech conglomerates demanding massive interconnected clusters of tens of thousands of GPUs just to train foundational AI models.
So how do they physically manage that? I mean, if you have $67 billion in new orders hitting your desk, operational execution becomes the single point of failure.
Oh, absolutely. The logistics are a nightmare.
And Magorek dropped a statistic on the call that frankly sounded almost impossible for a hardware-heavy business. A 97.5% global GPU utilization rate.
Yeah, in the realm of data center logistics, a 97.5% utilization rate is basically the absolute theoretical limit.
Meaning what, exactly?
It means there is practically zero slack in the entire system. Every single NVIDIA H100 or B100 chip they have racked and powered is actively running compute cycles for a paying customer.
So there's no backup, no chips just sitting around.
Nothing is sitting idle. Nothing is waiting in reserve.
They actually highlighted a specific renewal event in Q4 that beautifully illustrates the desperation in this market.
Oh, the 35,000 GPUs.
Right. They had 35,000 GPUs that were distributed across 59 different customers, and they were all coming to the end of their contract terms.
And this is where you really see the consolidation of power in the AI ecosystem. Because out of those 59 customers, only 49% chose to renew their contracts.
Wait, half the customers just walked away? That sounds incredibly bearish on the surface.
Hey, it does sound bad until you look at the actual physical hardware distribution. That remaining 49% of customers renewed 92% of the total available GPUs.
Wow. So the largest players simply devoured the capacity of the smaller players who dropped out.
Exactly. The dominant AI research labs and the enterprise giants understand that compute is the ultimate scarce resource right now.
It's like water in the desert.
When a smaller startup fails or just can't afford to renew their cluster, the big players instantly absorb those chips. They are hoarding capacity because they know the supply chain simply cannot produce GPUs fast enough to meet their training requirements.
And what happened to the remaining 8% of the GPUs that weren't renewed by that existing pool? Did they just sit empty?
No, they never even hit the open market. They were instantaneously recontracted to completely new customers within the exact same quarter. The utilization rate never even dipped.
Okay, I have to push back here, and this actually mirrors a critical point raised by John DiFucci over at Guggenheim Securities during the Q&A portion of the call.
I remember that question.
Because this all sounds fantastic when you are just counting the top line revenue, right?
Yeah.
But we are looking at a highly volatile global supply chain. The cost of raw components, specifically high bandwidth memory, solid state drives, networking optics, is fluctuating wildly.
Oh, component pricing is all over the place.
So if Oracle is signing fixed price, multi-billion-dollar contracts today that take 3 years to fulfill, aren't they absorbing a massive, almost catastrophic risk if the cost to build those servers skyrockets by, say, 40% next year?
It is probably the most important risk management question you can ask about this entire business model.
Right.
Because if Oracle gets the financial engineering wrong here, they could be on the hook for billions in margin compression.
Right. It would wipe out their profits.
But McGurk detailed a highly sophisticated contracting strategy that aggressively defends their gross margins. It operates on a strict bifurcated model.
Break that down for us. How does the bifurcation work?
Okay, so scenario one is the fixed price model. Oracle only signs a fixed price contract when the underlying costs are entirely known and locked in.
Meaning they already have the parts.
Exactly. This means the data center real estate is secured, the multi-year power purchase agreements with the local utility are already signed, the cooling infrastructure is priced, and the specific component prices from the manufacturers are totally guaranteed.
So no surprises.
Right. When they have 100% visibility into the unit economics, they bake in their margin and lock the price for the customer.
Okay, that is standard responsible enterprise contracting. But what happens in scenario 2 when the deployment is slated for 2026 or 2027 and there is zero guarantee what a gigabyte of memory will cost in 2 years?
In scenario 2, Oracle flat out refuses to assume the supply chain risk.
Really? They just pass it on?
They utilize floating cost mechanisms. If the price of components spikes by 20% before the hardware is actually procured, that cost increase is algorithmically passed directly through to the customer.
Wow.
Oracle's baseline profit margin is protected by the very structure of the contract itself.
I need to stop you there and view this from the customer's perspective because that sounds like a terrible deal for the buyer.
It does seem heavily skewed.
Why on earth would a major enterprise customer sign a contract where they assume unlimited upside risk on component pricing? Why wouldn't they just walk away and go to a competitor who offers a fixed price?
Because they physically cannot go anywhere else.
The utilization rate.
This is where the 97.5% utilization rate and the desperation for compute power we just discussed fundamentally alters the negotiating leverage.
They have them cornered.
The customer desperately needs the GPUs to train their model. If they delay their model training by a year, their competitors will crush them in the market. The cost of a 20% spike in hardware components is, frankly, negligible compared to the existential risk of missing the AI revolution entirely.
That's a great point. It's life or death for these companies.
Furthermore, the competitors aren't offering fixed pricing on future deployments either, because nobody has the balance sheet to subsidize that level of supply chain volatility.
Right, not even Microsoft or Amazon want that risk.
Exactly. Oracle has the leverage to dictate the terms, and they are using it to mandate margin protection.
That makes perfect sense. The scarcity of the asset dictates the terms of the contract. But there is another layer to this margin defense that I find absolutely fascinating, and it revolves around a $75 billion subsegment of their backlog.
The BIOH deals.
Yes, a massive portion of these new AI contracts are structured as bring your own hardware or heavily prepaid deals.
And CFO Hillary Maxson explicitly confirmed that these specific structures carry profit margins that are equal to, or often superior to, their traditional cloud infrastructure deals.
Okay, I really want to spend some time unpacking the exact mechanics of this bring your own hardware concept, because on the surface, it feels completely counterintuitive to the entire premise of cloud computing.
Oh,
right?
that sounds like a step backward.
The whole reason companies moved to the cloud in the first place a decade ago was to stop buying their own depreciating server racks. Why is a massive enterprise customer suddenly spending billions of their own capital to buy GPUs from NVIDIA, only to turn around and hand them over to Oracle to host? Why not just build their own data center at that point?
It seems backwards until you actually attempt to engineer the physical environment required for a massive AI cluster. McGurk went into deep detail on this. A cluster of tens of thousands of advanced accelerators is not a plug-and-play system.
It's not just plugging in a hard drive.
No, you do not just roll racks of servers into a warehouse, turn on the air conditioning, and start training a trillion-parameter model.
Right. The power density and the heat generation alone are on a completely different physical spectrum than a normal server farm.
The physical constraints are mind-boggling. But the real bottleneck is the networking and the orchestration. How these GPUs must communicate with each other in parallel at microscopic latencies. If one single node in a 10,000 GPU cluster stalls for a fraction of a second, the entire training run can desynchronize and fail.
Which costs millions of dollars in wasted compute time.
Exactly. So to support that, you need highly specialized general-purpose compute just to orchestrate the workloads. You need petabytes of high-speed, parallel access storage.
And a very specific network.
Right. You require intricate load balancers, identity management protocols, and arguably most importantly, proprietary networking architectures.
The prompt actually mentioned Oracle's specific networking technology here, Celeron. Can you explain the mechanism? How does a proprietary network architecture prevent a customer from just building this themselves?
So when you are transferring terabytes of data between chips in real time, standard Ethernet networking completely collapses under the packet loss and latency.
It's just not fast enough.
Not even close. Oracle developed specialized, low-latency networking architectures. They often leverage advanced variations of remote direct memory access over converged Ethernet that allow these massive data transfers to bypass the central processing unit entirely.
Wait, it skips the CPU?
Yes. The data moves directly between the memory of different GPUs. It provides the highest possible bandwidth at the lowest possible cost.
Wow. So the customer realizes they can buy the chips from NVIDIA, but they lack the decade of specialized network engineering required to make the chips actually talk to each other efficiently.
Precisely. Designing the data hall, securing the dedicated substations from the power grid, implementing the liquid cooling, and managing the hyper-complex network topology is brutally difficult.
Too difficult for a software company to do on their own.
So the customer utilizes their own capital expenditure to secure the ultra-expensive chips, but they hire Oracle to provide the facility, the power, the networking, and the software management layer.
Honestly, this is financial engineering at its absolute finest.
It really is.
Oracle gets to capture the high-margin recurring revenue of the management and networking services, but they successfully offload the massive capital depreciation risk of the hardware directly onto the customer's balance sheet.
It is brilliant. Oracle doesn't have to worry about a multi-billion-dollar cluster of chips becoming obsolete in 3 years because they don't actually own the chips. The customer takes the hardware risk. Oracle takes the service margin.
Okay, so while the AI infrastructure is clearly the growth engine right now, I want to pivot and ensure we don't ignore the legacy core of the company. Because Oracle built its entire empire on database software and enterprise applications.
Right, the stuff that runs the back office.
And the story behind the numbers reveals a massive, quiet modernization of this core business.
It is vital to remember that Oracle is still the central nervous system for a massive percentage of the Fortune 500. Their database business isn't just surviving, it is actively mutating to meet the modern cloud landscape.
And the specific metric here is wild. Multi-cloud database revenue grew by 404% year over year.
404%.
And the bookings for those services were up 325%.
That 404% growth is the direct result of a radical strategic shift by management.
How so?
Well, for the past decade, the major cloud providers operated like walled gardens. Amazon wanted you exclusively on AWS. Microsoft wanted you exclusively on Azure. And Oracle wanted you exclusively on OCI.
It was highly combative.
Very. But Oracle recently recognized that large enterprises are fundamentally multi-cloud. Like, a major bank might use Azure for their front-end web applications, but they still rely on Oracle databases for their core financial ledger.
Because it's too risky to migrate the ledger.
Right. So instead of fighting the customer's architecture and trying to force them to move everything, Oracle leaned into it.
They embraced the multi-cloud reality.
Exactly. They developed OCI-dedicated regions that can be deployed directly inside partner clouds or even inside physical customer data centers. They essentially build a mini Oracle cloud directly adjacent to the customer's existing compute.
And they cited Vodafone as the prime example of this during the quarter, didn't they?
Vodafone is a perfect case study for this. They are one of the largest telecom providers on Earth, dealing with massive, sprawling legacy databases.
Decades of customer data.
Right. And they chose an OCI-dedicated region to consolidate their entire operation. By bringing the modern cloud infrastructure directly to where their legacy data physically resides, Vodafone actually reported that their core processes are running up to 60% faster.
60%! That's a huge operational bump.
And simultaneously reducing their total operational costs. The 404% growth rate proves that enterprises are absolutely desperate for this kind of multi-cloud interoperability.
And this modernization extends directly into their software as a service too, the cloud applications. They added over 1,000 distinct AI agents across their application suite in just the past 12 months.
And this is a critical distinction for retail investors to understand. We spend so much time in the media talking about foundational AI models, like ChatGPT or Claude, but enterprise customers largely don't want to build foundational models.
They don't want to mess around with prompts.
Right. They want agentic solutions. They want an AI that is pre-trained, heavily secured, and deeply embedded directly into the supply chain software or the HR software they already use every single day.
I really want to dive deep into the specific real-world examples they provided here, because this is where the abstract concept of an AI agent becomes a tangible, physical improvement in a workflow.
Yeah, the real-world utility.
Let's look at the U.S. Department of Veterans Affairs. In Q4, Oracle added 4 new VA medical centers in Michigan and another 4 in Ohio. They now manage the electronic health records for 14 medical centers, supporting 29,000 clinicians and over 500,000 veterans.
The VA is arguably one of the most bureaucratic, hyper-complex healthcare networks in the entire world.
Exactly.
Clinicians there have historically been buried under an avalanche of administrative paperwork, dealing with super fragmented legacy IT systems.
It's a known nightmare for doctors. So how exactly does adding an AI agent to an Oracle database solve the VA's medical bureaucracy?
By intercepting the data at the point of creation.
What does that mean?
They are deploying AI clinical assistants that actively listen to the patient-doctor interaction in real time. The agent uses natural language processing to automatically generate the structured clinical notes.
Wait, so the doctor doesn't have to type it up later?
Nope. It also automatically queues up the required lab orders based on the spoken diagnosis, and it even formats the billing codes.
That is incredible.
It completely removes the clinician from the role of a data entry clerk. When you scale that efficiency across 29,000 clinicians, you are literally clawing back millions of hours of medical labor that could be redirected to actual patient care.
That's a complete game changer. They provided another massive example with Claro too, right? The telecom provider.
Yes. Claro is the dominant telecommunications provider in Latin America. They deployed Oracle Cloud Infrastructure and the AI data platform to automate the customer service workflows for 30 million subscribers.
30 million. Operating a telecom network for that many subscribers means dealing with a staggering volume of daily friction.
Oh, absolutely.
You've got billing disputes, network outages, upgrade requests, hardware troubleshooting.
And historically, solving that friction required massive, highly expensive call centers full of human operators.
Exactly.
But Claro possesses decades of proprietary, highly structured operational data sitting inside their Oracle databases. They know exactly how every network issue has ever been resolved in the past.
So they train the AI on that history.
Right. By overlaying Oracle's AI tooling directly on top of that proprietary data, the AI agents can actually reason through a customer-specific billing issue, decide on the appropriate credit or technical fix, and execute the work autonomously.
Without a human approving it.
Exactly. The AI isn't just providing a chatbot script, it is physically interacting with the billing software to resolve the ticket itself.
And Oracle is executing these deployments at an incredible velocity. I mean, they took over 300 customers live on their Fusion applications alone last quarter.
The adoption curve is steep.
The Wright County Sheriff's Office modernized their public safety software. Westfield Insurance migrated their enterprise resource planning. The U.S. government's Office of Personnel Management just granted them an agency-wide contract for human capital management. They are weaving themselves into the absolute core fabric of how municipalities, governments, and corporations function.
Which naturally leads us to the most critical and frankly the most contentious segment of the earnings call.
The management guidance.
Exactly. We have established the historical record. We understand the physical mechanisms driving the demand. But the numbers management projected for the coming years require a deep, highly critical examination.
Right, because the forward-looking top-line numbers are almost universally euphoric. For fiscal year 2027, management is guiding for total revenue to grow by 34% in constant currency.
Which is wild.
For a company valued in the hundreds of billions, a 34% total growth projection is staggering. The Q1 specific guidance expects cloud revenue alone to accelerate between 58 and 64%.
Those projections represent a complete acceleration of their long-term models. Previously, management had guided Wall Street to expect a 31% compound annual growth rate through the year 2030.
So they were already optimistic.
Right, but now they are openly stating that they will blow past their own highly optimistic multi-year targets.
But, and this is the elephant in the room that caused immediate anxiety across retail investing forums, to achieve those growth numbers, Oracle has to spend money. A lot of money.
A historic amount of money.
CFO Hillary Maxson dropped a specific guidance number that we need to thoroughly dissect here. She expects a net cash outlay for capital expenditures of approximately $70 billion in fiscal year 2027.
$70 billion in a single fiscal year. It is an astronomical deployment of capital.
And that $70 billion is strictly the net cash outlay. She also noted they expect an additional $20 to $25 billion in customer prepayments and timing impacts related to third-party manufacturers.
Yeah, so the gross reported CapEx footprint will actually be well north of $90 billion.
Which is I can't even fathom it. Furthermore, to finance this, they announced a plan to raise $40 billion through debt instruments and equity issuance.
Let's address the anxiety directly. Because if you are a retail investor and you hear that a company is suddenly going to spend $70 billion in CapEx while simultaneously diluting the stock or leveraging the balance sheet to the tune of $40 billion.
Your immediate instinct is to panic.
You're going to panic. It sounds exactly like the catastrophic overbuilding we saw during the dot-com bubble in the late 90s, where telecom companies laid millions of miles of dark fiber for internet traffic that just didn't exist yet.
Build it and they will come. So I have to ask the hard question here. Is Oracle building a $70 billion field of dreams? Are they just buying land and GPUs, hoping the AI trend doesn't cool off?
No. And understanding the difference is the absolute crux of evaluating Oracle as an investment right now.
Okay, clarify it for us.
If we connect this to the bigger picture, this is not speculative spending. This capital is fully backed, de-risked, and mandated by the $638 billion RPO backlog we discussed at the very beginning of the show.
Right. You cannot look at the $70 billion expense without simultaneously looking at the $638 billion in locked revenue.
Precisely. Oracle is not building capacity in the hope of finding a customer. The customer has already signed a legally binding multi-year contract.
They're already on the hook.
They have already provided billions in cash prepayments. Oracle is legally obligated to deploy this capital to fulfill the demand that is already sitting on their books.
Okay, let's look at exactly what that $70 billion is buying, because McGorrick provided a fascinating tour of their massive infrastructure projects on the call.
It's not just regular data centers.
Right. We aren't talking about renting space in a generic server warehouse. We are talking about building independent gigawatt-scale utilities.
The scale of these data centers requires a complete reimagining of the electrical grid.
Give me an example.
Let's look at the Shackelford, Texas site. Customer delivery begins in the first half of 2027, and they already have 115 megawatts of dedicated power capacity online, well ahead of schedule.
Just to give our listeners a sense of scale, 115 megawatts is roughly the amount of electricity required to power 90,000 average American homes.
And that is just one single site in their portfolio.
It's a small city's worth of power.
The power grid constraint is the single biggest bottleneck in the AI revolution right now. You cannot simply call the local utility and ask for 115 megawatts. The transformers and transmission lines literally do not exist.
It takes years to permit and build high-voltage infrastructure.
Exactly.
Which brings us to the fascinating site in Doña Ana County, New Mexico. McGork noted they are powering this site using clean, energy-efficient Bloom fuel cells. I need you to explain the mechanism here. Why is Oracle pivoting to fuel cells instead of just connecting to the public power grid?
It is a brilliant bypass of that utility bottleneck we just talked about.
Yeah.
Solid oxide fuel cells, like the ones produced by Bloom Energy, generate electricity through an electrochemical process, usually utilizing natural gas or biogas, without any combustion.
Wait, so they're basically generating the power locally?
Yes.
Yeah.
By deploying massive arrays of these fuel cells directly on site at the data center, Oracle effectively builds its own private, highly reliable microgrid. They don't have to wait 5 years for the state to permit a new high-voltage transmission line. They can rapidly deploy independent power generation exactly where the GPUs are sitting.
And the execution speed across these sites is stunning. In Abilene, Texas, they have already delivered 42% of the capacity, with another 35% slated for the next 90 days.
They're moving so fast.
They have mega sites in Saline, Michigan, and Port Washington, Wisconsin, coming online in late 2027.
In Q4 alone, they finalized a fiscal year where they delivered more than 1.2 gigawatts of power to customers.
And the acceleration is so violent that in Q1 of fiscal 27, they expect to deliver nearly 1 gigawatt in a single quarter.
Yeah, they are bringing as much capacity online in 90 days as they did in the entire previous 12 months.
But building gigawatt-scale data centers powered by independent microgrids requires immense upfront capital, which leads directly to the CFO's explicit warning about near-term profitability. Hillary Maxson clearly stated that gross margins will experience a temporary step down.
This is the critical financial mechanic that retail investors must internalize to avoid getting shaken out of the stock.
Because it's going to look bad on paper for a minute.
Exactly. It is the classic dynamic of short-term pain for long-term gain. When you build a data center, you incur massive upfront costs. You're purchasing the real estate, pouring the concrete, installing the fuel cells, laying the proprietary networking cables, and racking the servers.
Right.
You are bleeding cash before a single GPU is even turned on.
The expenses hit the income statement immediately, but the revenue from the client doesn't start flowing until the cluster is fully operational and handed over.
Exactly. That ramp-up period severely compresses the gross margins. The cost of goods sold spikes while the revenue lags behind.
So how does an investor evaluate whether this margin compression is actually worth the investment? If margins are stepping down, how do we know the ultimate payoff justifies the $70 billion capital outlay?
Maxson provided a highly specific framework for evaluating this. She urged analysts to focus on the return on invested capital, or ROIC, rather than quarter-to-quarter gross margins.
Walk us through how Oracle calculates that ROIC in this specific context.
The standard internal calculation they use takes the after-tax operating margin of the project, adds back the depreciation, and divides it by the gross investment at the project level.
Okay.
Based on their models, once these gigawatt data centers reach a steady operational state, Oracle projects an ROIC in the high 20s.
A return on invested capital in the high 20s for physical, heavy infrastructure is almost unheard of. Standard utility or telecom returns are often in the single digits or low teens.
It is an exceptional return profile. And what makes it incredibly compelling is that Maxson noted this calculation is actually highly conservative.
How so?
It does not factor in potential upsides. For instance, if the physical hardware outlasts its official depreciation schedule, every subsequent month of revenue is almost pure profit.
Oh, right, because it's already paid off.
Furthermore, when you factor in those bring-your-own-hardware contracts we discussed, the ROIC explodes even higher. Since the customer provided the capital for the expensive chips, Oracle's gross investment denominator shrinks dramatically, pushing the return percentage through the roof.
This brings us to the final segment of our deep dive, the bottom line. We have looked at the historical financials, we've unpacked the physical engineering and multi-cloud strategy driving the demand, and we've stress-tested the $70 billion capital expenditure guidance. So, what does this all mean? What is the official talk ticker's verdict on Oracle's Q4 2026?
Based on the structural evidence, the stance is highly bullish.
Highly bullish. I am in complete agreement, but let's synthesize exactly why the fundamentals support that rating, and more importantly, what it means for the retail investor listening to this breakdown.
It is highly bullish because Oracle has successfully executed one of the most difficult maneuvers in corporate history, the total architectural pivot of a legacy giant.
Yeah, that rarely happens successfully.
They have transcended their identity as an on-premise database vendor to become a Tier 1, indispensable artificial intelligence infrastructure powerhouse. And they haven't just surfed the wave of AI demand. They have actively engineered a highly defensible economic moat.
Let's define the physical barriers of that moat. Why can't a well-funded startup or even a sovereign wealth fund just replicate what Oracle is doing?
Because the moat is built on brutal physical complexity. It is the proprietary, low-latency networking architectures required to synchronize 10,000 GPUs.
The Celeron networks.
Right. It is the ability to negotiate multi-gigawatt power deployments and deploy advanced fuel cell microgrids. It is the capacity to integrate those massive infrastructure clusters natively into the mission-critical HR, supply chain, and telecom billing software that already runs the global economy.
You can't just build that overnight.
Operating a multi-tenant cloud at this scale requires a decade of specialized engineering scar tissue. The fact that the largest corporations on Earth are handing Oracle billions of dollars in upfront cash just to secure a reservation in their data centers is the ultimate empirical proof that this moat is impenetrable in the near term.
So let's make this entirely actionable for you, the listener. If you are sitting at home looking at your portfolio and you currently hold Oracle stock, what is the strategy?
If you're holding the stock, the strategy is ruthless patience.
Just hold tight.
You must actively ignore the short-term noise. Over the next few quarters, you are inevitably going to read sensationalized financial headlines about Oracle's gross margins contracting. You will see pundits on financial television hyperventilating over the sheer size of the $70 billion CapEx bill.
Or claiming that $40 billion debt and equity raise is massive dilution.
Exactly. They will see the $20 billion at the market equity issuance filing and immediately assume the company is starved for cash.
But you, as an informed investor, know the mechanical reality beneath those headlines. The $638 billion RPO is an unprecedented, mathematically guaranteed safety net.
It's the floor.
Every single dollar of that massive capital expenditure is tied directly to a legally binding customer commitment. The margins are compressing because they are physically building the factories that will print cash at a high 20s ROIC for the next decade. If you hold the stock, you're holding a locked-in, high-velocity cash flow engine with multi-year visibility. Hold your position.
Exactly.
And what if you were on the outside looking in? If you don't own the stock, but you are reviewing these numbers and considering initiating a position today, how should you frame the trade?
If you are considering buying, you must understand the time frame of the asset you are acquiring. You are not buying a short-term momentum tech trade. You are buying directly into a multi-year physical infrastructure supercycle.
It's a long game.
The artificial intelligence build-out is not a software fad. It is the fundamental physical rewiring of global computational power. The demand is outstripping supply so violently that global utilization is sitting at 97.5%.
Right.
Buying Oracle today means you are fundamentally betting that management can flawlessly execute the construction of these gigawatt data centers and successfully convert that $638 billion backlog into long-term high-margin cash flow. It is a long-term infrastructure play. Treat it as such in your portfolio allocation.
That is exactly the kind of clear, objective framework our listeners need. We are approaching the end of our analysis, so let's move to the outro. We will quickly recap the core pillars of this earnings call before leaving you with one final concept to examine.
So the summary rests on 4 pillars. Number 1, exceptional cash generation. Record Q4 revenue of $19.2 billion drove full-year operating cash flow up 54% to $32 billion.
Number 2, the backlog anomaly. The RPO exploded by 363% to $638 billion, securing a 3-year revenue floor.
Number 3, aggressive capital deployment. They are executing $70 billion in net capex to build gigawatt-scale, fuel cell-powered data centers entirely backed by customer demand.
And number 4, the highly bullish outlook. Despite near-term margin compression from the build-out, the projected high 20s ROIC paints the picture of a profoundly dominant infrastructure monopoly in the making.
Now, before we sign off, Talk Tickers always leaves you with a final provocative thought. We want to introduce a concept that builds on everything we've discussed today, but pushes the envelope further, something that could fundamentally disrupt the entire economics of the software industry.
Deep in the call, buried underneath the massive infrastructure numbers, Executive Mike Cecilia mentioned a seemingly minor detail regarding how they are pricing their new AI agents.
He stated that Oracle is actively introducing outcome-based commercial models.
Traditionally, enterprise software is sold on a strict subscription basis. It is the classic SaaS software as a service model. You pay a recurring licensing fee per user per month, regardless of how much value that user actually generates from the tool.
Exactly. For 20 years, software vendors have enjoyed guaranteed recurring revenue streams. The burden of generating a return on investment fell entirely on the customer.
You bought it, you figure out how to use it.
Right. But Oracle's outcome-based pricing radically alters that paradigm. For their new AI interview agents in the Human Resources Suite, they are not charging a flat monthly fee. They are pricing the software based on the actual number of candidates the AI successfully interviews.
That's a huge shift.
In the hospitality sector, the AI upsell agent is compensated by taking a percentage of the actual realized upsell transactions it generates. In healthcare, they are exploring pricing models based directly on patient throughput.
This requires a massive shift in how we value software companies. If the AI agent fails to successfully upsell the hotel guest or fails to properly process the patient, Oracle does not get paid for that compute cycle.
This raises a profound economic question for every investor. Are we currently witnessing the death of the traditional SaaS subscription model?
It certainly aligns the cost of the software perfectly with the value generated for the customer's business.
It does, but it does something much more disruptive. It shifts software from being categorized as a fixed capital expense or a static licensing tool and recategorizes it as variable labor.
Software as labor.
You are no longer paying for the potential to do work. You are compensating the software exactly as you would compensate a human employee based on the physical output of their labor.
Wow. If this outcome-based model becomes the new standard mandated by the enterprise market, it forces every software company on Earth to put their money where their mouth is regarding the true ROI of their products.
It demonstrates absolute supreme confidence from Oracle in the deterministic capabilities of their AI models. They're willing to bet their own revenue on the fact that their agents can successfully execute complex human workflows.
If the industry follows Oracle's lead, it completely upends the valuation metrics for the entire tech sector. We will start valuing companies based on monthly active users or recurring subscription rates, and start valuing them based on the total aggregate labor their autonomous systems can successfully physically execute in the real world.
That is a staggering philosophical and economic shift.
And it is something you need to deeply consider as you evaluate the long-term viability of every single SaaS company sitting in your tech portfolio right now. The rules of software economics are being rewritten in real time. Thank you for joining us for this deep dive into Oracle's monumental quarter.
It was a huge one.
We strongly encourage you to pull up the 10Q filings, review the specific infrastructure guidance, calculate the ROIC models for yourself, and as always, ruthlessly demand the data behind the companies you own. Stay analytical, stay objective, and we will see you on the next deep dive.